to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Kris Sidial, co-CIO of Volatility Trading at the Ambrus Group, to discuss volatility trends and outlook into the new year. Kris, it's great to see you again. Welcome back to Trade Talks.
Hey, how's it going? Thank you for having me.
You got it. Going well. Thank you. And what did you think of the volatility in the market with the Omicron virus headlines that we saw after Thanksgiving?
Yeah, I think it was a really interesting time. I think a lot of people were shocked to see the relationship that we noticed in the VIX to the actual SPX, right? So the actual beta that was being carried was something a little bit abnormal to most people, right? So it wasn't common to see, the S&P down less than 5% and, VIX kind of printing a 35 mark. And also, skew had risen up pretty substantially. But, I think for us, at least, this was something that we were kind of forward forecasting in terms of how the relationship to the market to vol would actually be going forward. So we're continuously seeing this dynamic where, the market is making these fast moves in these short dated timeframes, right? I think it was November 22nd, we were coasting around, kind of near all-time highs, and the market deleveraged about 1% in less than an hour. Right, which is something that is not really that typical, especially when you're thinking about all-time highs. So when you sit there and you tell people, the market could potentially move 20% in 2 months or so, they kind of look at you like, you're crazy. But it's showing us, that these moves could take place in these short-dated timeframes. And I think one thing that's very interesting about what's transpiring right now is, we all understand the growth of the derivative exposure that has hit the U.S. equity market, right? Everybody is participating in options as a whole. And I think what that does is it inherently changes the pricing of the VIX calculation, which inherently impacts a lot of other risk models around the street, right? So due to the growth of passive exposure, we're seeing a lot of passive products and even some hedge fund products out there that look to go to cash very fast during moments of market stress based on VIX pricing of volatility, right? So once volatility raises up, you'll notice people will say, okay, now's the signal to go to cash because of that actual VIX pricing, which is inherently based on the derivative pricing that comes from the SPX side.
You recently released a video covering tail risk. Why do you believe the tail risk is good in this environment?
Yeah, so I think we're bullish overall on U.S. equities, but I think the reflexivity that we're seeing from the dealer gamma hedging, and again the increase of the derivative exposure, and also the reach for yield, especially in the U.S. equity market, is something that's driving markets, right? Structured products have absolutely trumped, the market in Asia. The one in U.S. has trumped the market in Asia, which is very substantial when you think about the impact of the reflexivity. Right. And a lot of these things are interconnected. A lot of the names in the market is interconnected, like Amazon, Apple, Facebook, Tesla. So I think what we're seeing is it's one of those markets where the market could move up very fast, but at the same time, it could also make that sharp move down. And one of the ways how we view it is it's great to have this combination of being long the market, but at the same time having some sort of downside protection to protect you, right? You're participating in the upside and the growth in the forward forecast is what we're seeing, but at the same time, you're protecting yourself in a much more structured fashion.
Right. And let's talk about vol trends you're watching into 2022. We know that stocks have seasonality. So in other words, is there seasonality associated as you go into the new year when you're looking at the volatility complex?
Yeah, absolutely. You have these flows that come in, especially on a sector-wide base, right? I think one thing that's interesting is really the healthcare sector. I think healthcare vols have been crushed because of the COVID dynamic, right? So everybody's been massively bullish, a lot of the healthcare names. But I think going into this year, maybe towards mid of this year, you will actually see the market renormalize into looking at these stocks as stocks and no longer the only safe havens, because that's the kind of price action and flow that we noticed with some of these names, that the market doesn't believe that they could go down at all because they're kind of holding on to the narrative of the coronavirus. So I think healthcare volatility is something to definitely watch out for. I think we'll trade a little bit higher than a 10 vol. I think that's where the 1 month XLV vols have been trading as around like a 10 to 12 vol. So I think that's something that we should see. And then also, I think the high yield credit complex is something that is also something to just keep an eye on, especially with, you know, more of a hawkish take from the Fed. I'm not saying that high yield credit vols are going to blow out or anything, but I just think that it's one of those things in terms of value. It could be an area that could be pretty interesting if we notice a little more hawkish tone from the Fed going forward towards the middle of the year.
All right, Kris, finally, tell us about your panel you have coming up the week of December 13th.
Yeah, so we have a panel with you guys on tail risk hedging, and you know we're very excited about it because again we've been kind of pounding the table out there in terms of saying, you know, this is really the way how you should be looking at markets, and portfolio construction is participating in the upside and the potential that we see in this market, specifically in U.S. equities, but at the same time, you know, making sure that you're participating in a safely and effective way, right? That's really the case. So, you know, the idea of tail risk hedging is something that could be a little bit complex to most people's, but we want to shed some light and kind of give some insight as to how you could apply it and why it's really important to an overall portfolio. So, you know, if a scenario like March of 2020 happens again, people aren't going to lose money on their bonds and gold and you know, their regular equity exposure. You know, it's one of those things where you won't have to worry about losing, you know, 3 ways down the line, and structuring something that's much more effective than your traditional way of looking at portfolio construction.
All right, Kris, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me.